Welcome back to AlgoBot, your channel for clear, practical breakdowns of automated trading strategies for MetaTrader 5. I'm your host here at AlgoBot, and today we're studying an expert advisor called Regression Breakpoint Trend. This one is built on a genuine piece of econometrics, the Chow test for structural breaks, applied directly to price. Instead of waiting for a moving average to catch up, it asks whether the linear behavior of price has just changed. By the end of this video, you'll understand how it detects that change, how it decides direction, and how it manages risk. Let's get into it. So what exactly does Regression Breakpoint Trend do? At its heart, this is a trend emergence strategy. Rather than trading the middle of a move that everyone can already see, it tries to identify the precise moment a trend changes character. It does this with a statistical tool borrowed from econometrics called the Chow test, which is designed to detect a structural break in a relationship. Here's the framing. On each newly closed bar, the strategy takes a rolling window of the most recent closing prices, 40 bars by default. It fits a straight regression line through the whole window, then splits the window into two equal halves and fits a separate line through the older half and the recent half. If a single straight line still describes the data well, splitting it barely improves the fit. But if the trend genuinely broke, the two-segment fit is far tighter, and the Chow F-statistic measures exactly how large that improvement is. Direction comes from the recent half of the window. For a long, the recent slope must be positive and steeper upward than the older slope. For a short, the recent slope must be negative and steeper downward. A magnitude filter then requires the recent line to have traveled at least a fraction of the current ATR, so the strategy skips statistically real but trivially small wiggles. Everything runs on a single time frame, and the natural home for this approach is a liquid instrument, such as a major currency pair or a metal on the hourly or 4-hour chart. In terms of who it suits, this is educational material for traders curious about statistically grounded, systematic entries rather than discretionary chart reading. As always, remember that trading carries real risk, and losses are a normal part of any approach. Let's walk through the mechanics step by step. The expert advisor works strictly on closed bars, so it evaluates once per bar rather than reacting to every tick. When a new bar closes, it rebuilds its window of recent closes and runs the Chow test. First, it fits 3 regression lines, one pooled line over the entire window, one over the older half, and one over the recent half. From these, it computes the residual sum of squares for each fit and combines them into the Chow F-statistic. The formula divides the improvement from splitting the line by the residual variance of the two-segment fit, scaled by the degrees of freedom. A larger F means a more decisive structural break. Next comes the acceptance test. The F-statistic must exceed the break strength input, which defaults to 6. A higher value makes breaks rarer and stricter. A lower value makes the strategy more sensitive. On its own, though, F only tells us that something changed, not which way. That's why direction is read from the recent segment slope. For a long signal, the recent slope must be positive and steeper than the older slope, showing the trend turning up. For a short signal, the recent slope must be negative and steeper downward. Then the magnitude gate is applied. The recent line's fitted travel, its slope multiplied by its length, must span at least the minimum rise ATR multiple of the current ATR. This filters out breaks that are statistically significant but too small to be meaningful. The strategy also debounces its signals. A fresh emergence signals only once. The direction must reset to neutral before the same side can signal again, which prevents it from re-entering the same break repeatedly. If an opposite emergence appears while a position is open, the strategy flattens the existing trade and reverses a stop and reverse. Before any order goes out, a spread filter checks that the current spread is within the max spread points limit, keeping fills realistic. Risk is handled entirely through ATR. The protective stop is placed at the ATR stop multiple times ATR, and the target at the ATR target multiple times ATR. By default, that's 2 times ATR for the stop and 3.5 for the target, which frames a reward to risk of roughly 1.75 to 1. The position volume and a magic number round out the settings. Let's look at the actual MetaQuotes language code the expert advisor runs. At the top are the key inputs. Windows sets the rolling regression length, 40 by default, and it's forced even so the two halves are equal. BreakStrength is the minimum Chow F-statistic needed to accept a structural break, set to 6. Minimum rise ATR is the magnitude gate. Then we have the ATR period and the stop and target multiples, 2 and 3.5 times ATR. Below that is the direction block. The variable signal direction starts at 0. If the break condition and the magnitude condition are both true, the code compares slopes. If slope B, the recent half, is greater than 0 and greater than slope A, the older half, the signal becomes +1, an upward emergence. If slope B is less than 0 and less than slope A, the signal becomes -1, a downward emergence. Now the two signal blocks. When the signal is positive, the code checks whether a long is already open. If so, it does nothing. Otherwise, it closes any existing short and calls open trade with the buy flag. When the signal is negative, it mirrors this. If already short, do nothing. Otherwise, close any long and call open trade with the sell flag. Inside open trade, the stop and target are computed from ATR. For a buy, the stop sits below entry and the target above. For a sell, the stop sits above entry and the target below. Finally, the code places the order trade.buy for a long and trade.sell for a short, each passing the lot size, the symbol, the stop, the target, and a comment tag. That's the whole entry and risk path in a handful of lines. Now let's bring the logic to life on a chart. The panel below the candles shows the Chow F-statistic, our structural break measure, with a horizontal level marking the break strength threshold of 6. Remember the key intuition: when price is either flat or moving in one steady, unchanging trend, a single regression line already fits it well, so the F-statistic stays low. It only spikes when the character of the trend actually changes. Look at the opening candles on the left. Price is drifting gently lower and then flattening out. During this stretch, the older half and the recent half of the window look much alike. One line describes them both. So down in the subpanel, the F-statistic sits well below the threshold. There's no structural break here, and the strategy stays flat. This is exactly the kind of quiet, indecisive market the Chow test is designed to ignore. Then watch the middle of the chart. Price stops drifting down and begins to lift, and the next candle pushes up decisively with a strong close. This is the moment the recent half of the window turns clearly more bullish than the older half. In the subpanel, the F-statistic jumps above the break strength level of 6. Both conditions the strategy needs are now satisfied. The break is statistically significant, and the recent slope is positive and steeper than the older slope. That combination produces an upward emergence, and the buy entry marker appears. Notice the magnitude gate also passed. The recent line covered enough ground relative to ATR to count as a real move, not a wiggle. With the long open, the protective stop is placed a distance of 2 times ATR below the entry, and the take profit target is set 3.5 times ATR above it, the roughly 1.75 to 1 reward to risk framing we discussed. Now follow the next few candles. Price continues to build higher, each candle closing above the last, riding the freshly detected trend. As price reaches the take profit marker, the long is closed for a completed target. Interestingly, while this clean trend runs, the F-statistic actually settles back down, because once a single new slope is established, one line fits it again. The strategy has already captured the emergence and isn't looking to pile in. Now the market shifts again. Near the highs, price stalls and prints a top. Then the following candle drops firmly with a weak close. Here the recent half of the window turns clearly more bearish than the older half. Down in the subpanel, the F-statistic spikes back above the threshold of 6, a second structural break, this time to the downside. Because the recent slope is now negative and steeper downward than the older slope, the strategy reads a downward emergence, and the sell entry marker appears. If a long had still been open, this opposite signal would have flattened it and reversed, the stop and reverse behavior built into the strategy. For this short, the stops mirror the long. The protective stop sits 2 times ATR above the entry, and the take profit target is placed 3.5 times ATR below. Follow the final candles as price works its way down, each one closing lower, until it reaches the take profit marker and the short is closed at its target. Step back and notice the pattern. The strategy did nothing during the flat, indecisive opening, then acted twice. Once as the trend turned up and once as it turned down, each time at the change point rather than long after. That is the whole idea behind trading structural breaks. Catching the moment the linear behavior of price shifts, confirmed by both the statistical test and the direction of the recent slope, and then letting ATR-based stops and targets define the risk. Every one of these signals is illustrative only, of course. Real markets produce false breaks too, and losses are part of the process. That brings us to the end of our breakdown of the Regression Breakpoint Trend Expert Advisor. We covered the core idea of trading structural breaks with the Chow test, how the strategy fits 3 regression lines and compares slopes to decide direction, how the magnitude and spread filters keep signals clean, and how ATR defines the stops and targets. Hopefully you now have a clearer sense of how a statistically grounded trend emergence approach is built and automated. Remember, everything in this video is educational information only and not financial advice, a recommendation, or a solicitation to trade. If you found it helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with any strategy you'd like us to explore next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.